We tend to think that building wealth requires high-level math, complex charts, and raw intelligence. But the truth is, 90% of financial success has absolutely nothing to do with the mechanics of finance. We are taught to view investing as a hard science, a strict discipline where data and formulas dictate exactly what to do. The problem with this approach is that you aren't a spreadsheet. You are a complex, emotional human being. Your baseline relationship with money isn't anchored in pure logic at all. Instead, it is heavily shaped by the specific slice of history you happen to live through. Take someone who grew up in the booming economy of the 1950s. Their worldview was forged in a period of predictable growth, leading to a lifelong comfort with steady investment and a deeply held belief that markets generally work in their favor. Now, compare that to someone who came of age during the dot-com crash or the 2008 financial crisis. Their formative experience is watching trillions of dollars of household wealth evaporate. Two highly intelligent people can look at the exact same market data and assess the risk entirely differently, simply because of when they were born. It is incredibly easy to build a theoretically flawless portfolio on paper, but academic plans rarely survive their first encounter with reality. Looking at historical returns cannot simulate the agony of watching your life savings drop 30%, wondering if your family's future is in jeopardy. Because wealth accumulation is a psychological game played with mathematical rules, raw intelligence will not save you from panicking at the worst possible moment. To succeed, you have to learn to manage your own mind. The first major psychological shift required to build wealth is redefining how we react to inevitable market crashes. This chart tracks the Dow Jones Industrial Average over several decades. Look at the dense cluster of vertical gray bars. Each one represents a time when the market dropped more than 5% below its previous all-time high. Our natural instinct is to view those steep, sudden drops as a fine. We feel like we made a mistake, and our immediate reaction is to sell our assets to stop the punishment. But zoom out, and those painful drops are swallowed by a massive upward trajectory. Volatility, fear, and uncertainty are not a fine. They are a fee, the required, unavoidable price of admission for long-term growth. Think of it like buying a ticket to Disneyland. We willingly hand over $100 because we know the experience inside the park is worth the cost. We don't view the ticket price as a penalty. We have to adopt that exact same mindset for market returns. Recognizing volatility as a fee neutralizes the panic. It gives you permission to endure the terrifying moments, allowing you to stay invested long enough for compounding to actually work in your favor. It's incredibly easy to get derailed by the constant stream of negative financial news. Cynical, pessimistic advice always sounds smarter and more intellectually captivating, while optimism often looks like you're just ignoring the risks. The most durable investors survive by developing a hybrid mindset. You must save like a pessimist, building large cash reserves and margins of safety, while investing like a long-term optimist who expects the market to eventually recover. This page from Morgan Housel's book highlights a counterintuitive rule. Aiming to be mostly reasonable works better than trying to be coldly rational. Traditional financial advice treats emotionless investing as a badge of honor, but an investor who feels absolutely zero emotional attachment to their portfolio is actually incredibly fragile. When markets crash and the math looks terrible, a purely rational investor has no emotional anchor, making them highly likely to abandon their perfect strategy at the first sign of trouble. A reasonable investor who genuinely loves their slightly imperfect strategy has a massive edge. That emotional commitment provides the endurance to hold steady during the rare, terrifying days when everyone else is losing their minds. Managing your emotions gets you through the crashes, but long-term wealth faces another major hurdle, the passage of time, and the challenge of planning for a future version of yourself you haven't even met yet. Psychologists call this the end of history illusion. We easily recognize how much we've grown and changed in the past, but we routinely underestimate how drastically our personalities, desires, and goals will shift in the future. This graph illustrates the magic of compounding, which relies entirely on leaving your money uninterrupted for decades. But if your rigid financial plan breaks every time your life goals shift, you interrupt that growth and reset your progress back to zero. To survive your own evolution, you must build flexible plans with massive room for error. Instead of creating extreme rules, like assuming you will happily tolerate an 80-hour workweek forever, aim for a moderate balance that you can realistically sustain over a lifetime. This warning emphasizes the danger of copying the strategies of friends, colleagues, or TV talking heads. You have to beware taking financial cues from people playing a different game than you are. A teenager trading momentum stocks and a widow protecting her retirement funds might be buying the exact same asset, but they are playing entirely different games. If you blindly copy the moves of someone with a completely different time horizon, you will sabotage your own long-term objectives. Ultimately, the true purpose of wealth is not beating the market or hitting an arbitrary number on a spreadsheet. It is simply using money to buy control over your own time, ensuring you build a life that lets you sleep well at night.